Yeah, previously we have used two different models to determine the optimal asset allocation. The Corners portfolio approach and the Black Litterman model. And the key on that two model, of course, is based on the mean variance allocation. But importantly, that the asset class determined or defined from these two models is arbitrary. Like you arbitrarily define your asset class, like classified by equity versus bond versus real estate, or you can use different type of class based on the style, or maybe using different industry. But those are all arbitrary. Now another model, very interesting model, is called the factor-based allocation model. So instead of looking at the optimal allocation among asset classes, it focuses on the optimization from a set of portfolio sensitive to asset pricing factors. Okay, so this is the model focused on asset pricing factors. Why this is another very popular approach, especially in the hedge fund industry. Many hedge fund portfolio like to use this approach to determine their optimal allocation of their portfolio. Is because based on one of the a very good article published in 2013 at the Financial Analyst Journal. These two researchers find that if you compare, all right, the model, I'm going to explain it to you later, is called their factor approach. If you compare a factor approach versus the asset class, which is based on like you know arbitrary asset class based on the style, based on different things, arbitrary, and they find that on average, right, on average, the factor approach perform better when we have a higher when we're facing higher risk. Higher the portfolio risk, actually factor model perform better than other type of the asset allocation model based on arbitrary asset classes. So therefore, the factor approach become a good alternative way to outperform the general market. That's the reason why a lot of hedge fund manager like to use that. I'm going to spend a little bit of time to explain the idea about that. First of all, factor means asset factor, asset pricing factor. And asset pricing factor is a risk factor. All right. So, for example, capital asset pricing model (CAPM). There's only one factor. It's called market factor, and that factor focus on the market portfolio return. All right, market portfolio return. Suppose we got the market factor here, so we focus on market portfolio return minus minus the risk-free rate. Minus risk-free rate meaning that you actually have a short position of the cash. That's the reason you minus. So the portfolio return minus the risk-free return, meaning that for the market factor, the factor actually you have a long position at the market portfolio like S&P 500, and then you have a short position on cash. That means that you are shorting your borrowing, right? Minus risk-free rate meaning you borrow money to buy the market portfolio. It is a long short position. Therefore, any factor is a zero cost portfolio with long short position. Why zero cost? Basically consider short, meaning you sell the cash, you get the cash, you borrow cash, and use the cash to buy the portfolio. So you have no cost, basically no cost. So if this being the case, then so we want to do some way to construct this portfolio based on the factors. So which means that I'm able to create the factor mimicking portfolio by using long short. Mimicking portfolio, meaning that I can truly using the tradable security by long short, and I can create that risk factors premium. For example, another very famous risk premium called size risk premium by Pharma Friends three-factor model: size, value, market. So how do we mimic size factor? Well, here we're going to do the real trading, right? So how we do, right? So we're going to short the large cap, and then we use the money from the shorting the large cap to buy the small cap. Okay, so for example, we got two ETF, large cap ETFs, Spider, and then we short that one and then buy the small cap, right? Russell 2000 ETF. Then we able to create a size factor. That's interesting, right? It's a mimicking portfolio. So the value of risk, what you do, all right. So you're looking for the ETF that actually can really track the growth stocks with a high PE, and then you short that ETF. Then you buy the value tracking ETF based on the low PE. Then you short one and long one, you got a value factor. See, these three factors are very commonly used. Now, here there's another three factor I need to explain it to you. The credit factor. You always have to remember, in addition to these risks, credit risk is an issue. Very important one. Right? The credit is risk. That credit risk implicitly determines the asset price. So that way it's going to affect the portfolio return. So we need to create a factor there to taking care of that premium. Right? Premium meaning the risk premium on that. So what we do here is to short the treasury bond. For example, we can short a treasury bond futures contract, and then we long a corporate bond. Okay, we use that money to, we can short that one, and then we long. You can use both the futures contract if you want, but or you can use the cash market directly using short and long if you have the dealer capacity to do it. Then you're able to create the credit factor. Many hedge funds had ability to do that. Another type of risk, one is called the interest rate risk. All right, so we talk about price risk, equity price risk, we talk about credit risk. What about interest rate risk? This is another factor we always consider when then we use the short position in the treasury bill, which is a very short term government bond. Right, this one has no risk, right? I mean no default risk. And then long, we loan the long-term treasury bond, which has no default risk. So these differences here, long minus short minus long-term bond minus short-term bond, which is a short-term bond and long-term bond, you will have a premium for duration, which is the interest rate risk premium. And another one in the reading talk about mortgage. I think this is very important, right? The mortgage, say you can short the treasury bond, right? Could be say long term, 10-year. Then you long the 10-year MBS, mortgage-backed security, which is a government agency bond, right? The agency bond, MBS. So what does that tell you? The MBS had no default risk. Treasury bond had no default risk. Both as backed up by the government. So what the risk you're talking about here? All right. So what do you mean the mortgage risk? Now we learn from the interest rate risk model. We talk about convexity. There's a term called negative convexity. It occur in MBS and also occur in the callable bond. The callable bond, all right, the risk they are facing, the firm issue callable bond, is that the buyer for the callable bond, they're facing the risk is what? Is that would be the bond will be redeemed earlier by the firm, will be called back. So as the MBS is what type of risk? The the house owner, the homeowner, they own the mortgage owner. The one had a mortgage. They may the mortgage lender, right? The banks gonna face risk that the homeowner, the mortgage, they will like to do redeem earlier, refinancing, early redemption. This early redemption will cause negative convexity. You need to study this negative convexity one more time by yourself. So this type called the redemption, early redemption risk, capture what? Capture the reinvestment risk. Reinvestment risk. When we talk about the overall risk from the fixed income security, one is interest rate risk, the other is the reinvestment risk. Think about the early redemption. The reinvestment return become lower because early redemption. You're facing lower return. So it's early redemption is we call the reimbursement risk from the for the portfolio holder. Therefore, here we got the six different type, actually five different type of the factor. Of course, first one is cash factor, risk-free rate. That one we know is 3-month T-bill. You don't need to show anything. So the risk factor, including market size, value, credit, right? Credit risk, duration, interest rate risk, and the mortgage risk is the reinvestment risk. So this is one of the very interesting and important approach to construct the factor-based portfolio, right? The optimum portfolio with the factors. So learn that one, and maybe one day you serve for some kind of hedge fund, you may use this model.